Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular market review, Breaking the Mould, I'm going to look at what's going to cause the biggest fuss in the coming week. Now, my feeling is that planes, property and the post are going to hog the headlines because we've got full year figures from airline Easyjet on the 17th, interims from British Land on the same day, and first half figures from Royal Mail on the 19th. So, let's start, and first up it's Easyjet, and the FTSE 100's firm's full year figures, try saying that in a hurry, on the 17th of November. Now, as you can see from the chart behind me, the shares have had a bit of a turbulent ride this year, although they are still within touching distance of what is an all-time high were you to take the chart further back. Now, the spring slump that you can see, well, that was caused by a fire at Rome's Fiumicino airport and some network disruption, but boss Caroline McCall looks to have a firm hand on the controls. September's trading statement raised guidance for full year pre-tax profits from 620 to 660 million pounds to 675 to 700 million pounds. Record high load factors and passenger volumes have helped here, while currency movements and, let's face it, the low oil price have caused very few bumps. So when it comes to looking at the statement, keep an eye on load factor, cost per seat and revenue per seat, and also the dividend, which is expected for the full year to come in around the 55p mark compared to 45.4 pence last year. That's enough for a dividend yield a fraction above 3%. Now, International Airlines Group, the parent of BA and Iberia, did see its shares dip a little after October's third quarter results, but then it recaptured that lost ground. So let's see how Easyjet responds to what on the face of it should be pretty decent numbers. Now, on the same day as Easyjet's full year figures, we get interims from British Land. As this second graphic shows, the shares have basically gone sideways for the last 6 months, albeit again after a very strong run in the preceding few years. It'll be therefore interesting to see if the numbers can galvanise the stock, as activity has been good, notably further lettings at the Leadenhall building skyscraper, better known to you and I as the Cheese Grater, and the New Mersey shopping park. Key numbers to watch include overall portfolio valuation, which was up 18.4% in the year to March, rental value growth, which was 4.6% last year, and finally net asset value, or NAV, well, that was 829 pence per share according to the full year figures, and that compares to the current share price of around 825 pence. The third FTSE 100 stock to note in the week ahead, well, that could be Royal Mail with its first half figures on the 19th. The government sold its final stake in the company in October, and some, but not all, of the heat looks to have gone out of the debate of whether the 2013 flotation was underpriced or not, as the shares have actually retreated from a peak above £6 to around the 445 pence mark, as our final chart here shows. Now, the recent slide may be due to some indigestion caused by that government sale of stock, while summer's regulatory review from Ofcom that suggests Royal Mail has breached competition law may not be helping either. The company does operate in a mature market where frankly growth is limited and competition still pretty hot, as evidenced by the July's first quarter update, which revealed flat sales on the back of a 5% drop in letter volumes and a meagre 3% increase in parcels. Cost cutting should help the profit and loss account, but the company's earnings profile is likely to be, well, pretty pedestrian, so any investment case for Royal Mail is more likely to rest with the dividend. Last year's interim payout was 6.7 pence a share, and the market may be looking for a small increment here, as consensus calls for a full year distribution this time of around 21.75 pence, up from 21p last year. That's enough for a 4.9% dividend yield as I sit here today, so let's see what Chief Executive Moya Greene finally delivers. Thank you for watching, and I look forward to seeing you next time.